You can see it even just in the investment process as we use the large language models. There's no thought of emotion. They don't really care what the market's doing. They, in some ways, have no sense of what the portfolio, the underlying portfolio that they create is even really doing, which I think in most cases is a superpower. A good human analyst probably really knows 20 to 30, maybe 40 stocks if you're really pushing it really well for their own personal investment universe. But these models, they can know thousands. And in fact, they can probably know more even on those 20 to 40 that the human knows. The bet that we've been making at Intelligent Alpha is that if we fast forward the clock a decade from now, that the AI-powered asset management industry will be a multi-trillion-dollar AUM industry.
Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Jack Forehand is a principal at Validia Capital Management. Justin Carbonneau is a managing director at Life and Liberty Indexes. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital.
Hey guys, this is Justin. In this episode of Excess Returns, Jack and I talk with Doug Clinton of Intelligent Alpha about using AI to build investment strategies with the potential to beat the market over time. We talked to Doug about what LLMs actually do behind the scenes, how to prompt them when building investment strategies, the pluses, the minuses, and where things may go in the future with AI and investing. Doug is putting his AI strategy to work with a recently launched Intelligent Livermore ETF. As someone who has been investing in companies at the cutting edge of technology, it's good to get Doug's perspective on the intersection of AI, investing, and where things are headed in the future. As always, thank you for listening. Please enjoy this discussion with Intelligent Alpha's Doug Clinton.
Hi, Doug. Thank you very much for joining us today.
Good to be with you guys as always.
Always a pleasure to have you back on Excess Returns. We've had you on in the past to talk technology trends and the things that you guys focus on at Deepwater, but today we're going to spend, I think, more time focusing on sort of a new venture, although not too new. And we've touched on this to some extent with you in the past, but we're going to talk about how you build and deploy AI-powered investment strategies. And I think we want to spend some time sort of getting under the hood and exploring how sort of the nuances of this, how you've tackled it, some of the complexities of using large language models, things like ChatGPT, in developing a stock selection strategy. You have a new ETF that you launched last year that's powered with these AI strategies. You run a number of different indices that you're tracking live out of sample performance data on, which is always important. Obviously, with the ETF, you have an actual track record. You're developing one. So, you know, you're pretty, I don't know if there's other people doing this. You may know that better than me, but I think you were early on in terms of trying to really figure out, is there something here with these LLMs and investment strategy? So again, thank you. And yeah, this should be good.
Yeah, I mean, I'm excited to talk to you guys about Intelligent Alpha. And just for quick context background, we launched Intelligent Alpha last year. So we formed the company kind of Q1, Q2 of 24. It came from an experiment that we actually started in the summer of 2023. And so we had this question at Deepwater pretty simply, you know, can we use ChatGPT at that time just to beat the S&P 500? And so ever since that initial experiment in the summer of 23, we've been tracking a few dozen now different strategies where we use a combination of different large language models as an investment committee to build stock portfolios. And then, as you mentioned, Justin, we launched our first product for Intelligent Alpha, which is the Livermore ETF. The ticker's LIVR, where that uses our process that we use for all of our strategies, committee of GPT, Gemini, and Claude on the large language model side. They kind of look at and are inspired by, I would say, the world's great investors. They try to think like those investors and then build a portfolio of 60 to 90 stocks that represents what those investors would do in the world, given what the environment is right now.
And just remind me again, are those indices being tracked somewhere? Where can I find those?
Yeah, so as part of forming the company, we also registered Intelligent Alpha with the governing body, the SEC. And so we've had to restrict, because of our registration, some of the numbers and performance that we used to share. So those indexes are now tracked internally. We still track all the same ones. Kind of the TLDR, I can just give you a little bit of a sense there, is there's about 3 dozen different products we track there. the overall performance on a net basis, the majority of those indexes are beating their benchmarks since inception, which is that roughly summer 2023 launch date.
The wonderful thing about being a regulated entity is that you got to pull all that stuff behind the curtain now, unfortunately.
That's right. Yeah, you get to hear more.
So before we get into sort of some of the details on this, what do you think what would be both the strengths and weaknesses of AI versus a human professional investor?
The biggest strength, and the one that I see most obviously when we do our work with the large language models, is the lack of emotion. And I think that's something, you study the great investors, you read everything that Buffett wrote. I think so much of it really centers around the emotional traps that human beings fall into. We get excited, euphoric when everybody else is really excited, that chases, we get FOMO, we get scared when stocks go down. And that emotion often causes us to make bad decisions and biased decisions. And so with AI, you can see it even just in the investment process as we use the large language models. There's no thought of emotion. They don't really care what the market's doing. They, in some ways, have no sense of what the portfolio, the underlying portfolio that they create is even really doing, which I think in most cases is a superpower in markets. In terms of weakness, I think one of the things, and this may not be a weakness forever, depending on how the models evolve, but I think abstract thinking still, the human advantage still is in creativity, right? It's in finding, the stock that's going to 10x for some reason that the models just, for whatever reason, they can't understand today. Maybe in the future, they will be able to understand it. But I think that's the thing where, the models are, you can almost think of them in between, an index, a quantitative approach, and a human. It kind of takes pieces of each of those and I think creates something that's very effective in the middle. But over time, I think it'll be able to do even more of the things that humans can do that we can't right now with AI.
If I were to go to any one of these LLMs, ChatGPT, Gemini, and give it a prompt, what are the 10 best stocks for 2025? Blah, blah, blah. Something where I'm trying to get it to spit out what it thinks the best investable opportunities are in the market. I've tried it. In some cases, sometimes it gives an answer depending on how you prompt it. Sometimes it just gives you here's a framework for how you'd get at. But just in either of those instances, what is going on? Can you just explain and maybe talk about the process in which it lists specific ideas, specific names? What is actually happening within the model? And maybe it's different for each of these models, but just pick one, what's actually happening behind the scenes.
So the way that the transformer architecture works, which is what these models are built on, is that the models are trying to figure out, what is a logical sequence of words that creates a response that makes sense relative to the input from the user, right? And so how do I make that sound a little bit simpler? Essentially what the models are doing, and they will do this is why we get hallucinations, they are going to give you an answer that in some way makes sense. To your point, it might be a framework in some cases, it might be a list of stocks in other cases. What we found is that the more structure you can put around the prompts and inject some appropriate data, useful data, the models are much more intelligent and much more, I would say, deliberate about how they actually go through the stock picking process, just like a human being. If you went to a human being on the street who didn't really know anything specific about stocks, didn't have any, earnings data or revenue data, and you just said, hey, tell me 10 stocks that you think you'd like, what they would probably do is tell you 10 companies that just come to the top of their head. So it might be Home Depot, it might be Google, it might be Meta and Apple. And that's probably what you're going to get for the most part if you just go to an LLM today and just ask it for 10 favorite stocks.
So would it give you basically the stocks it has the most information on? It would give you the NVIDIAs and the Apples, and if you just did a very, very simple prompt, that's what it would return?
That's what we have found. Absolutely. It just kind of goes toward where does it have the most information? If you were going to do a search, imagine if you did a search on Google for, what are the top 10 stocks? Again, you'd probably get NVIDIA and Google and Apple, all these names that people have written a lot about, people talk a lot about. that's what you would get from the LLMs as well.
So if you're using one of these to find possible investments, there's obviously an infinite number of ways that you could kind of approach it. But would you say, do you have an opinion, I guess, could you give the model maybe a little bit of data and then let it work? Or would you sort of find that, more specific detailed prompts is probably going to give you a better output?
I love this question because we've actually tested this a lot over the last couple of years. And we found there's actually sort of like an efficient frontier where you want to balance giving the models enough data, just as giving a human enough data to sort of understand the important parts of the company. But you don't want to give it so much structure that it's just becoming like a glorified screener, right? Where you tell it literally everything that you want it to look for in a stock. And then it just becomes an optimization around a bunch of, quantitative metrics, which can be fine as an approach. But I think you kind of lose the secret sauce and the special the special additive value that the LLMs can bring. And so we try to go somewhere in the middle where I think there is certainly a structure and a specificity to the prompt that is useful, especially so that it understands what kind of portfolio is it building, right? Is it a long short portfolio? Is it a global portfolio? Some of the details around that, how it should think about risk. I think those are all great parameters to help the models understand. And then also a little bit of data too. So, just like a human analyst would have maybe a sheet where you've got revenue and earnings and what are expectations from consensus going into the year, giving that data to the LLMs too is super useful.
Yeah, the more you talk, the more I think about this in the same way I think about a human being. Like if I go to my neighbor right now and say, give me the 10 best stocks to buy, I'm probably gonna get a bunch of garbage back. Like if I go to one of the world's best investors and say, give me the 10 stocks to buy and give them very specific information, I'm going to probably get a much better list. It's almost like it's the same spectrum you see with these types of things.
That's absolutely right. And I mean, that's sort of the mission that we have in Intelligent Alpha is we want to replace the human component of investment management on the analysis side and the portfolio management side. And we think that we can do that. And I referenced this a little bit before, but I really do think one of the best ways to think about using large language models as an investor is as sort of an evolution of the quantitative finance movement, where obviously these models can understand quantitative information and they can act like a traditional quant model. But what they have that traditional quantitative finance models really don't have is that qualitative understanding. It's able to understand, Apple makes cell phones and people like iPhones for whatever reason, right? And Advanced Auto Parts sells auto parts, where a quantitative model, a traditional quant model, really doesn't care about that, right? They're looking specifically just at metrics. And I think it's that marriage of we can understand metrics, we can overlay a little bit of that unemotional qualitative understanding of what these companies do and what their opportunities might be. That's where I think you run into kind of this special outcome where you get a little bit of best of both worlds, quant side and human side.
How do you think about the LLMs you're using? I think you mentioned you're using Gemini, you're using GPT, and you're using Claude. How do you pick those? Are you just trying to get the biggest players in the space right now?
So we started with GPT. That was kind of the first one we tested just because in 2023, they were sort of the obvious leaders. And I would say the leaderboard has gotten much tighter. And the way I describe it is at the beginning of 2024, like to me, OpenAI was clear, far and away, top of the leaderboard. And then, Claude, Gemini, Llama, some of the other models were very clearly in second place and below. I think the leaderboard has compressed a lot over the last year. OpenAI to me is still the leader, and they've done some amazing things with advanced reasoning and O3. But I think we've seen the models get a lot better just in aggregate. And the reason we use the three that we do is we do some testing where we've looked at each of them individually. We've looked at Grok, we've looked at Llama, we've looked at several of the open source models, and we found that sort of subjectively and objectively, the three that we use, GPT, Gemini, and Claude, tend to give us the best results. So they tend to understand what they're asking, what we are asking them to do. And then also the performance of the portfolios that they've generated have been more stable relative to some of the other models.
Yeah, to your point on the models in general, it's amazing. I use these things all the time now, not for stock picking, but I use them all the time. And it's amazing how fast they're evolving, but also how that leaderboard can move back and forth. Like I think Claude is doing like really exceptional stuff right now. But then I'll go back to GPT and I'll use it for a specific thing and I'll say, wow, it's doing way better than it did even like 3 weeks ago. It's just amazing how fast these things are evolving.
It's crazy. I mean, everybody says it's like, months are happening in weeks and weeks are happening in days. And I think it's true. Like sometimes that analogy feels like an exaggeration, but it does feel true in the AI world right now. And one thing that I think is really fun, just observationally, so we're always doing testing of models at Intelligent Alpha. And one of the more recent phenomena in the model space is this timescale inferencing, which is basically the idea of if you let models, just like human beings, think about the prompt that you give it longer, you tend to get better answers. And so that's really what O1, OpenAI's model they launched a few months ago, is built on. And what we've seen with the models that use inference as a function of thinking longer, they've actually had some better results in some of the recent tests, which they should, hopefully. If you give a human being more time to think about their portfolio, you would hope they'd get better results too. So you even see fun stuff as these models have evolved and changed how they actually function, their ability to generate better portfolios and hopefully better performance over time as well.
How different is the output from the models? Like I assume, and you can correct me if I'm wrong, I assume you probably prompt them in fairly similar ways. Do they produce similar stocks or are they really, really different?
That changes over time too, actually, which I think is kind of fun to think about why that might be. But what used to happen was that GPT and Gemini tended to give fairly similar portfolios if I rewind the clock like a year ago, and Claude tended to be the more contrarian of the models. I would say now GPT actually seems to be the more contrarian of the three models that we use the most, whereas Gemini and Claude now tend to think a little bit more alike. I think some of that has to do obviously with a function of what is the underlying training data for each of these models, because that's going to dictate how they think. But that does evolve over time too, which is fun to think about, and also kind of a challenge we have to consider as we build our portfolios in terms of how much differentiation versus consensus we want in those underlying portfolios.
Yeah, I think that'll be an interesting thing to think about for you over time too, because you will, as you do this for longer, you'll start to develop a track record with each individual model. And then you have to think about, if one of these models just ends up being better, do I weight that model more in the future? Or, I mean, I guess Grok and some other models could come in, but like thinking about how do you evaluate the performance of them individually must be an interesting thing to think about.
It is. And in some ways, you can actually, I think about it almost like some of these multi-manager or multi-strat shops think about it, where obviously they have, in some cases, hundreds of different PMs. Obviously, each of those different PMs are performing in different ways. And those PMs, when they perform really well, get more money to manage. I think that's something we thought a lot about. How should we structure that at Intelligent Alpha? And it's definitely on our roadmap in terms of trying to do performance optimization, I think we would call it, relative to model selection and weighting.
Yeah, we just did an episode on pod shops recently, and like it's very like a very similar thing. I mean, you're not pulling out all the risks like pod shops are, but the idea of like flowing more money to the better managers, might work here too.
Absolutely. And I mean, conceptually, I think it's kind of fun to think about, okay, what could be an end state, or like, blow out the idea of using large language models for any type of investing. I mean, you could conceivably build a structure where you have a pod model where every pod is a different, fine-tuned LLM to think about the world in a specific way. An energy expert, a macro expert, all of them having a long and short book. And you could even have an overlay on top of that, which is your sort of portfolio manager or risk management layer, just like a pod shop. So I think there's a lot that can be done there. I'm sure there are firms that are experimenting with that. But I mean, I think you could imagine a world where anywhere we have human analysts and PMs, they could be replaced in some ways by large language models.
I want to ask more about how you think about prompting these, because it's interesting. You're trying to track great investors. So obviously you have to give them information as to what those great investors did or what it can learn from them. I mean, obviously it's got its own information as well. And then you've got to think about what data do I give it? Do I give it fundamental data? Do I give it, you have a lot of information probably about technology in general. What do I give it? So how do you think about that in terms of what you tell it, in terms of how you model great investors, and then what types of data you give it besides what it already has?
We found that to also be this sort of efficient frontier where you want to give it enough data to help it understand the specifics of the task. Because the models, all of these models already have a very general understanding of any task that you might ask of it. And so you think about the sort of training data sets. Effectively at this point, all the major models and even the open source models, I think of them as they've been trained on all of the data that's available on the internet. And if you conceptualize that in your head, it's like, all right, well, they know a lot about pretty much anything I might want to ask it. And so your job in using an LLM effectively is really like, okay, if I'm going in a specific domain, what about that specific domain might those models not know from their training data? And how can I optimize their understanding of whatever that specific domain is? And so to answer your question, Jack, is when we think about how do we help these models understand some of the world's great investors, some of it is pointing to more recent material that may not be in their training data sets because a lot of these models have cutoff dates that might be several months old. So making sure things are current, that's one big effort. And then also making sure things are specific enough about maybe some of the best writings or the best thoughts or some of the most effective investments in the past that these great investors have made, making sure the model understands, this is how this investor thinks, this is what's made them successful and why they're successful. That we find is also helpful to create the general structure. And then once we go past there, then we kind of get into some of the specific stock related data. And again, that comes back to probably a lot of the things that quantitative managers use. I would guess that if I think about the amount of data the quantitative manager might use for their strategies, we probably don't use as much data. I don't know if I would quantify us as, a tenth or a half or a quarter, but something probably like that. It's a little bit more of a limited data set, but still substantial enough so that the models can understand the underlying businesses.
I just want to jump back to the multi-model pod shop sort of thing just for a second. And tell me if I'm like, this is a crazy question, but I mean, could you, if you're allowing these models to compete against each other, which that's kind of effectively what it would be, could you then circle back around and tell a model that it's losing the competition and so to like improve itself? Or is that way too much like, then you're getting them to actually think like humans and that's too far out in left field?
So we've actually thought a lot about this particular question in a slightly different way. We call this introspection for the model, which is think about, why you might pick a certain stock or believe that a certain thing might happen in the world, and then challenge yourself, why might it happen? And in some cases, you can actually have the models sort of debate each other is another tactic that we've worked on. And so I think the spirit of your question is, could you give models more information or kind of force them to think a little bit more about what might be working, what might not be working in terms of the application of strategy? The answer is yes. And I think that is one of the ways, just like a human being might adapt their performance depending on how they're doing, learn from their mistakes. The same thing can be true with these models. Yeah. Part of the challenge, just to get into a little bit of the nerdy nuances here, is that these models at the moment don't have simple structured memory, like a human being will remember, especially the painful lessons. Those are the ones you remember the most. The models don't have that, which in some ways is a superpower, but in some ways is a weakness. So you kind of have to almost bring in important memories, at least for now, back to the surface for them.
You think?
And do you have specific, you don't have to name them, but do you have specific great investors in mind that you're modeling, or are you trying to model just great investors in general when you think about your prompting?
Both. I think generally, I would say our base strategies tend to have sort of a growthy value tilt or GARP tilt. I think that may be a reflection of how I like to think about the world, for better or worse. There may be some bias built in there. Of course, there always is when humans get involved. But that's kind of the base philosophy. And then I would say, we use as inspirations the names that you would expect: Buffett, Peter Lynch, right? George Soros, Stan Druckenmiller, names I think everybody would probably agree are on the Mount Rushmore.
That makes sense. And it goes back to what we talked about before, because depending on who you're telling it the great investors are, you can have a very different experience. So for instance, if I tell the model, I want you to be Benjamin Graham, and I want you to buy cheap price to book stocks, it has been a catastrophe in the last 5 years.
Yeah.
So I guess you do have to figure out, like, for the world we live in, who are the great investors I think are worth following.
That's true. Yeah. And I think that again gets to this idea that we use a lot, which is efficient frontier of how much of a push do you want to make one way or the other, right? Like if you say Benjamin Graham and you really want the models to optimize price to book stocks, the models can certainly do that. Another way to do it is to say, we really like the concepts of value investing broadly. And obviously that theme has been more challenged over the last decade, really at this point. You could ask the model, how would you structure a value-oriented portfolio in the current regime where, indexes are sort of dominant, the big companies tend to get bigger, right? You can have the model, I think about how it might adapt that strategy without giving it the answers to the tests that historically have been, associated with whatever exposure you're looking for.
How much of any of this is fundamental data based? Like, I assume it doesn't have access to CompuStats database or something like that. And you mentioned before, a lot of times they probably don't even know what the price of the stock is once they decide to pick it. So like, is something like NVIDIA's PE ratio, is that playing a role here, or is this really completely different things?
It does in our process. So we'll pull in, we don't use CompuStat, but we use some other third-party, well-known data sources where we do pull in price data, PE data, earnings, revenue, things like that, free cash flow. So that's something that we do think is important for the models to understand as they're picking these stocks. We want to give them that sort of quantitative grounding so they at least know, okay, how expensive is this stock on some metric? And then pair that with the qualitative piece that we talked about before, where it's kind of okay, the stock may or may not look expensive on a purely quantitative basis, but qualitatively, what are some of the elements of this company that I think might be good or bad going forward?
I want to bring you in on the debate we've been having a lot in the quant space, which is that there's this idea in like factor investing that our factors have to be intuitive. So I want to start with something that makes sense, and then I want to test it. But that's kind of getting turned on its head, in recent times, because we're finding a lot of strategies that work and we don't necessarily know why they work. I'm wondering, how do you think about that with respect to this? Like, how much do you know about why these models are picking these stocks, and how much do you care that you know the reason versus you just know that they have a good process that they're using?
I think it's a little bit of both, because we have to understand, at least generally, how the models are picking, working, functioning, so that we can explain to our investors how the process works. Explainability, I think, in AI, whether you're in the financial services space or in any other space, is a huge component of having people trust the process and trust the AI. And so I think the explainability piece is really important. How the AI, or what the AI unearths, to your point, I think, that I think can be a little bit more, we call it, the part of the magic that's in the process, where even if you talk to AI engineers, they couldn't give you the full explanation of exactly, like, line for line, or literally like character for character, why a model might be returning something. And so we can't do that either. But I think there's something within that is, if we can at least understand and explain the process, and then have at least an intuition of why does the model think a certain way based on all of our experimentation and work with the model, just like we might have to explain how a human PM thinks. I think that's kind of the perfect balance to the process.
Will it tell you why? So if you have XYZ stock in there, can you prompt it and say, give me the biggest reasons why this particular stock you've selected for the portfolio?
It does do that, yes. And as part of our process, we often ask the models to provide a rationale with its stock pick, because we tend to see you get better answers. And as a general rule, like what I would say with large language models, working with them, the more you force them or ask them to explain themselves, to explain their process, the more that the machine, the AI, actually has to go through a process just like a human being. And so you tend to get better results when you ask for more information, or back to the idea of introspection, when you ask for sort of a why analysis, or how might you improve this analysis, it does often improve your results, at least on the surface. And then I think over time, it should improve your returns as well.
How do you think about testing? This is something that I think is very different probably than our quant world. Like in our quant world, we want to test something. We want to have in-sample data. We want to have out-of-sample data. We want to have, results over a really long period of time. But with these, that's not really possible. So on one hand, I look at that and I say, well, that might be a weakness of these. But on the other hand, I say they really have all available information available to them. So do I really need to just get rid of this whole backtesting process? Do I need to really think about, is backtesting necessary for a model like this?
Yeah, well, we have a very specific view on backtesting. I would say I think quants are generally very smart people, much smarter than me, that understand math at a different level. And what we're doing with these models, I think, is something that's a little bit different, where math obviously is playing a role in our process and within the data that we present to the models. But I think a lot of what we're doing is actually trying to create structured creativity for the models, like a world to sort of be constrained by, but also act within and be creative within. And so it's a little bit of a different process, in my view, as I think about what's the difference between using large language models versus traditional quant models. But to answer your question specifically about backtesting, I think backtesting using large language models is almost useless. And there's a few different reasons for that. The biggest of which and the most obvious of which is that most of these models have a non-current cutoff date in terms of where their training data set ends. And so I think if I remember, I was just looking at, I think it was Gemini, it could have been Claude, but their training data ended in August of 2024. And so there's 5 months now basically of data about the world that model doesn't understand unless you make sure that you find a way to inject it into the model. And so if you were going to perform a backtest, any backtest that would go past August of 2024, the model already has the answers. And we do see in some of our tests, because we'll still backtest just to look, but you do see in backtests that oftentimes when the model has the answer, it will make sure the portfolio kind of reflects what did actually work in the past. And so I think when we backtest to the extent that we do, we'll only look at the data up to whatever today is, and the cutoff is whatever the training data cutoff is, because we feel like at least then the model doesn't already have the answer within its broader training data set.
Yeah, because it's not like you could go to the model and say, know only what you would have known in March of 2000
That's right.
and, run the same thing. It doesn't work that way, right?
It doesn't. I mean, you could certainly try that. In my view, I think that your answers would probably still be pretty reflective of reality, because I don't think the model would fully grasp or embrace not knowing what was in his training data.
So I want to dig into a little bit of the portfolio construction stuff that we quants always focus on behind the scenes. And I want to start with the investment universe. Like, how do you think about telling it because obviously you probably don't want a stock, with $1 million market cap in there or something. How do you think about telling it what the universe is it can choose from?
Sometimes it's easy where if we're going to create, let's just say a large cap U.S. equity strategy, that universe is pretty well defined. You just do a screen of stocks above, let's just say $15 billion in market cap based in the U.S. Those are easy. Where it gets a little more challenging is when we try to do more dynamic portfolios, something like our Livermore strategy for our ETF, something like we're about to launch an LP structured product later this month for qualified investors. That has a little bit of a more dynamic universe. And the answer to the question is, it sort of depends. We always try to start with what is the broadest universe that makes sense for the strategy that we're trying to implement. And in some cases, we'll try to pare down that universe by using the LLMs themselves. And so that might be the LLM saying, here are specific themes or specific sectors that I want to focus on for this particular strategy. And that will help us narrow down that universe a little bit. But that's the general process. Is either it's super easy because the strategy is fairly basic and targeted at something where there's a defined universe, or it's something where, we're starting with a very broad universe and using the LLM and the strategy that we're sort of building with the LLM to help cut it down into something more manageable.
I think you mentioned you hold between 50 and 100 stocks before. How did you think about setting that number?
It varies depending on the different strategies. So that's the case for our Livermore strategy. Our LP structure strategy that we have coming up is also in the same general range. But we have some strategies that hold 200 to 300 different stocks, and we have some strategies that hold as few as 10 to 12. And for the most part, we have thought about the world as sort of, concentrated portfolio exposures or very broad portfolio exposures. For the broad portfolio exposures, those are the kinds of strategies where we're just benchmarking against, the S&P 500. We're trying to create just a comp that we think would be like an AI-powered version of large cap U.S. equity exposure. So that's easy. You want something that might have 200 or 300 stocks in that scenario. For some of our more concentrated strategies, we are trying to be in that 10, maybe 30, maybe up to 50 kind of holdings range, where we want the AI to be more convicted in the names that it's trying to pick because we're trying to generate more excess return. We're not trying to just create something that has relatively low tracking error and maybe a little bit of excessive return relative to a benchmark. The concentration is a reflection of us going for more upside in that strategy.
Is the AI giving you position sizes too, in terms of how big it wants each position to be?
It does, yes. And we set parameters around those too, depending again on the strategy. For things, in the ETF world, obviously there are specific rules that we have to comply to in terms of sizing of various positions. For example, we can't have a single holding over 25%, as one example. But we'll have specific rules. Generally, we'll tell the models that they shouldn't have position sizes over 5 or 10%, depending on the size of holdings in the strategy. But we do ask the models to weight their picks based on their conviction.
And how about sector concentration? I would think these probably tend to pick a good number of technology stocks. Do you think that's something that should be restricted over time to a certain percentage in each sector, or do you think you should just let the model roam as it wants to?
We've experimented some with that. And so we do have some strategies where specifically we will tell the models to think about sector exposure. In some cases, we might even exclude certain sectors, again, just depending on what the strategy is. But I think that's something as we think about kind of our roadmap and into the future and thinking about different customer sets we can serve, that sector exposure, I think, is a question where we often hear it more from an institutional client relative to a retail client, where the institution is looking more specifically, I think, for, orthogonal alpha. They want to see things that are neutral in terms of sectors, factors, beta, and that requires a little bit more work, obviously, on our end. We're building some products around that. But for our more general strategies, I would say we usually let the models sort of roam and go where they think is best.
How do you think about how often you rebalance, and also whether you limit turnover? Do you want to have if the models want to change every single stock every month or something, would you put some limits in there to say, like, that's not a great idea?
Again, it depends on the strategy. So generally, for most of those 36 strategies that we track, most of them are quarterly kind of portfolio reviews is how we view it. For some of the more aggressive strategies that we run, like this LP structured fund I mentioned, that one we look at more every 2 to 4 weeks, sometimes every 6 weeks, just depending on, how the portfolio is performing, what's the market environment. We're kind of constantly having the LLMs actually think about the portfolio, even though we're not changing stocks in it. So it depends on the strategy. And then in terms of the turnover, we've used a few different approaches to that. I would say generally we sort of let the models have free rein, because that's the purpose in our mind, is just have this be a reflection of what AI thinks are the best stocks for whatever specific strategy we're working on. In some cases, if we're doing something that is very long-term oriented, as an example, we might only allow the AI to switch out 1 or 2 holdings every review period or something like that. So it's easy to put limitations on it, and that's usually how we implement it.
I almost wonder if this could be used as like a direct indexing type of framework or strategy. Like if you were able to, hold something like the S&P 500 and then give the model like the rules around when to tax loss harvest and what type of replacement stocks. I mean, you might be able to sort of get like an automated direct indexing strategy. I know you're running active strategies. I'm just making a comment here as I'm thinking about like the investment process side of it. It's just an interesting question, I think.
I think it's absolutely possible, and we've actually looked into that world a little bit. Something that we'd be open to. I think that again, some of the broad strategies that we track, where we're trying to specifically create broad, U.S. equity exposure. Again, we'll just use the S&P as an example because it's easy. I think we could implement our strategy, and to your point, add on some intelligence about tax loss harvesting, and hopefully try to create not just a little bit of tax alpha, but also some return from better stock selections as well.
Is there any part of the process that a human steps in? So, for instance, if the models came up with a stock that had accounting issues or something, does a human review these, or is there any other part of the process where you think a human adds value to what the models are doing?
So we do have a human oversight layer, which basically happens at the end of the process. So a human obviously is sort of at the top of the process, helping figure out the investment universe and what the strategy intention is, things like that. Then once the models sort of ingest all the data, perform all of the analysis that we're asking it to do, and we have a base portfolio, a human looks at that to make sure that there's no, hallucinations or stocks that are in there that shouldn't be. If there's a Chinese equity in a US equity portfolio, obviously we'll take something like that out because the models can still make some mistakes. And I think that for now, at least, that human oversight layer is an important part, going back to the idea of explainability, where the most explainable thing is always that, well, a human is overseeing this still. It's AI powered. We're giving all of the decision-making power essentially to the AI to build the portfolio, but we are still taking that final step to make sure that nothing went awry, where the portfolio is completely, irrelevant for whatever strategy or exposure we're trying to create. And by the way, we've actually never had any egregious issues with hundreds at this point of different portfolio reviews. The worst we usually get is like, a small cap stock will somehow find its way into a large cap strategy. That's the most frequent problem we run into.
We've gone over some of these already, but I was thinking before we did this, I was like, probably the best thing I could do if we're going to talk about the pros and cons of Claude as a stock picker is let's ask Claude itself. What are your pros and cons? So I did that. And the first one it came up with was its ability to process and synthesize vast amounts of information quickly, which I think would probably be one of the biggest advantages over a human, because I think no matter how much and no matter how smart I am as a person, there's no way I could process as much data as these things are processing.
100%. I mean, you think about it this way. I think a good human analyst probably really knows 20 to 30, maybe 40 stocks, if you're really pushing it, really well for their own personal investment universe. But these models, they can know thousands. And in fact, they can probably know more even on those 20 to 40 that the human knows. They probably know more, if you just objectively would test the models on it. Now, that brings us back to kind of the creativity of the human. That's still where the advantage is. But I think 100%, if you think about what is one of the biggest strengths, aside from lack of emotion for these models, it's the scalability of knowledge and the breadth of the knowledge that they bring to the investment universe.
And the other one it came up with that I thought was interesting was the idea we talked about before, that they can work 24/7. But my question around that is, like, do you have them working fairly regularly? I mean, is it just around when you're going to rebalance that you're having it look at the portfolio, or is it something where on an ongoing basis you have them analyzing things pretty regularly?
We do have an ongoing process. It's not 24/7. And I actually think there's actually something important in there too, where Ben Affleck, funny to bring him up in an AI conversation. He had this incredible quote about the difference between sort of art and AI. And he said, AI, is doing the work, but knowing when to stop, that's art. And I'm paraphrasing. I think I probably butchered the quote. He said it way better than I did. But the point of the quote, I think, is really beautiful, which is you could have these models work on figuring out a stock, thinking about a stock around the clock, persistently, forever. And it would probably be a function of the stock or the LLM just giving you roughly the same answer in a slightly different way over and over and over again. So it kind of becomes pointless. This idea of sort of knowing when to stop, I think, is still part of how does the human element, right? Whether it's an engineer or somebody who's overseeing the technology still, how does the human think about what's the right time to have these models think a little bit more? Is there new data? Is there something where the model can have a new opinion that's worthwhile? Or is it just, if you said a human analyst and said, tell me what you think about Apple every minute on the minute for the next 24 hours, it's not going to change that much. And so I think you can think about the models the same way.
And I just wanted to do one weakness before I hand it back to Justin, because I thought this one's interesting. It said, can't adapt to unprecedented market conditions or paradigm shifts. And I'm wondering about that. Like, say, China invades Taiwan or some sort of massive change happens in the world. Like, how do you think about these models' ability to continue to select stocks in a world like that where something changes really dramatically?
I think the conventional wisdom, most people who are at least curious about using AI to invest would agree with that statement. They would say, okay, it's great. Models work when the market's going up. Everybody kind of looks smart. But when the market has volatility, the models will fail for one reason or another. They might point to the quant quake, 15 years ago now. It seems forever ago. Something like that, where we have some evidence where these models can have issues at times. I would probably take somewhat the other side of that bet, just because there's different ways that you can have these models think about the world. And I'll give two specific examples. I mean, one way that you can kind of guarantee that the models don't make an egregious mistake is make them think a little bit like indexes, which is you only have them review their portfolios on a set schedule. And so you're not going to make some crazy mistake if the market blows up any more than the S&P 500 would, right? Now, you wouldn't take advantage perhaps of an opportunity, but if the question is, could these models blow up? I think that's one approach, a very simplistic approach to the problem. I think the better approach, and the thing that we've been trying to build at Intelligent Alpha, is these models are capable now with tools like Perplexity. GPT is now building in real-time search and web index to understand the world today, at the moment. Grok doing the same with Twitter data. I think these models now more than ever are actually more capable of understanding kind of the status of the world currently. And so I actually do think they can be either now or in the near future capable of adapting to these volatile market conditions just like a human could. And I think because they don't have that emotional bias, they may prove to be better than the human would be in that case.
What do you think this means for the future of stock picking? I was reading one of your articles from earlier in the year, and you were kind of talking about Intelligent Alpha and, moving quickly, and why big firms, will be slow to get into this. It's messy, it's complicated. They obviously have their current product shelves that they may not want to cannibalize, but, just in, when you guys think about the future and AI-driven investment strategies, could there be a future where there's like hundreds of AI models just competing against each other, or is that not really likely going to happen? What do you think?
I think there could be, just like there are hundreds, even thousands of different funds that are run by humans that have different flavors, different strategies, different focuses. I think you will find in 10 years that the same thing happens with AI. So there will be funds that focus on emerging technology. There'll be funds that focus on, global equities and everything in between. And I really do think that's the future. I think where human analysts and PMs will have a challenge competing is if they're just doing some, plain vanilla strategy, AI will probably do that better. If they find a strategy that is really differentiated, unique, it requires some level of creativity or ingenuity, well beyond, just looking at simple PE ratios and saying, this is a quality company. I think that's where human managers are going to find themselves being able to add value in the world of AI. So it will get more competitive in many ways. I think AI can bring down the cost, obviously, to implement those, plain vanilla type strategies. And hopefully, and this is my optimism, people always worry about humans losing jobs to AI. I actually think it just creates a stronger competitive environment for the best humans to stand out even more. And so in that future world where creativity is at a premium, I think you'll see some really creative human investors doing things that maybe we've never seen done before, because the structure of the market will really push them to think outside the box, because most of the other stuff is being done by AI.
It's interesting. To your point, I was listening to an interview, I believe it was with Gavin Baker, recently, and he was saying that exact same thing. He was saying that he thinks humans with the assistance of AI is going to be a great opportunity for great fund managers to get much better than they are now.
I think he's 100% right. And it's, again, something we've experimented with at Intelligent Alpha too. I mean, our vision is really to try to sort of replace the human component of investing. But we've also experimented with the augmentation potential for, can you make a human manager better if you give them some of these tools? Maybe free the human manager from thinking about specific things, going super deep on certain stocks, and just thinking more broadly about portfolio construction and your end customer. What do they want? How do they trust you? Things like that. That might be how the world shapes as well.
Or, the big problem is we're running out of ticker symbols for ETFs. So the more strategies that come on, the more shortage of tickers there's going to be. But you got a good one, actually. So you kind of locked in on LIVR, right? LIVR? That's correct, right?
LIVR, yep.
Yeah,
Livermore.
cool.
You got lucky.
Yeah. Okay, so just in closing here, let's kind of come out of the investment sort of space for a minute. And that was great, Doug. Thank you very much. This is evolving so quickly, so it's going to be just important, I think, for people that are in the business and whether you're a quant or a stock picker, to sort of understand this and how it's being deployed. And you guys are sort of on the front edge of it. So, thanks for sharing all this with us. I want to ask you, sort of outside of using AI for stock selection, what are the other things that you're most excited about with this technology outside of investing?
At the end of last year, so in December, OpenAI put out their O3 model, some of the benchmarks that they achieved that were, I thought, outstanding. And really, I don't think the market has priced in this concept of, how close, and you could get into a real philosophical debate of how close are we to AGI? What does AGI even mean? But the TLDR to me, just for anybody who's not familiar, the O3 model is OpenAI's sort of top of the line AI model at this point, on a test where basically the model is asked to solve some puzzles that it's never seen before. It scored, I think the highest score it had was like a 91, if there was no constraints on how much compute it could use, how long it could think, essentially. And the human benchmark is 100%. And so we're 9 percentage points, that model was 9 percentage points from a human being. I think that is incredibly powerful, because one of the criticisms of these AI models is they'll never be able to think like a human, right? They can't reason like a human being. They can't create de novo sort of intelligence or creativity, learn something new if it's not in their training data. And I think that achievement with O3 suggests that maybe that's not true. And the reason I find that really exciting is even before O3, go back to GPT 01, right? Or even the model before that, 4.0, like AI as it is today is already powerful enough to do so many things. Like, think about how effective ChatGPT is anytime you ask it a question. I mean, it's amazing. And so that already has the power to transform a ton of businesses. So to me, there's like all this latent potential, even if AI doesn't get any better than it is today, to make the world a much more efficient place, to superpower human beings, right? To help them think faster on their feet, to deliver better customer service. I think that's one of the most obvious use cases, better sales outreach, stuff like that. But that's not where we're going to stop. My excitement about where these models are going as we head into 2025 and thinking about what might 2026 look like, we might get pretty close to AGI. And I think that's great for humanity. I think that's great for applications like investing, because then the models will start to be able to think a little bit more creativity like human beings. And we were talking about before, kind of what was the human advantage? I think it is that creative abstract thinking. In the future, and maybe even the near future, these models might have that power as well.
Do you think it's a foregone conclusion with OpenAI transitioning to, like, kind of going from nonprofit to profit, that the path for them is a publicly traded company? I mean, is that a done deal, you think?
It seems the most obvious and likely, and also just you think about their capital needs too. If I remember the last thing I read, I think they burned several $billion last year. Obviously, they're spending a lot to build their leading models, and I think that at some point there's probably some limit to how much money the private markets and primarily, I mean, the hyperscalers like Microsoft really are going to be able to invest directly in OpenAI, and not own the underlying technology. Obviously, Microsoft has some rights in their agreement, but if we get to AGI, as we just talked about, I believe the way that contract works is then, the exclusivity that Microsoft has is no longer. So I think eventually that probably means that there's a path that OpenAI sort of needs to go public, just to keep raising more capital to keep developing the technology.
How far do you think we are from the personal assistant? Because that seems like it's one of the killer apps for this whole thing is I can just talk to my phone. It can book travel. It knows everything about me. Like it knows my calendar. It can basically do anything. It can be like what a personal assistant would be, but just a digital one on my phone. Do you think that's way far out or do you think that's close?
I would put the over-under at probably 2 years. I think we'll start to see some early implementations of that this year. This year, 2025, and this is probably consensus at this point, but still worth stating, I think is really going to be the year of the agent, the AI agent. And so the year of the agent is a step, Jack, toward what you're talking about, where an agent, if you say, book me a flight to Vancouver from Philadelphia, an agent can understand that query. It understands that it needs to find your frequent flyer number, your credit card number, find the right times for your schedule, all those things. Where today, if you just went to ChatGPT and said that, right, you're not going to get a useful answer. And so that agentic AI world, as we start to see what are those products and implementations, I think they'll be sort of one-off in many cases this year. Maybe it'll just be a flight booking service. In 2026, I think you might get to see some of that stuff come together and build into something that looks more like that assistant that we would all envision.
So one last standard closing question, Doug, and it's a new one for us that we're asking all of our guests, which is, what is the one thing you believe about investing that the majority of your peers would disagree with you on?
The bet that we've been making at Intelligent Alpha is that if we fast forward the clock a decade from now, that the AI-powered asset management industry will be a multi-trillion-dollar AUM industry. So just like we've seen this boom in ETFs and indexing over the past 20, 30 years, I think you will see a similar boom in AI-powered investing. Some of that will look active. Some of that might look a little more passive. Some of that might look even a little more exotic. But I think when we're here chatting in 2035, I think Cliff Asmus just did a prediction piece, 2035.
Yeah.
My prediction would be that we'll see a few $1 trillion being managed by AI.
Good stuff, Doug. Thank you very much. We really appreciate it.
Thank you, guys.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.